All right. Hello, you trader nerds. Real traders never trade alone. They trade with their fellow nerds. We got 12547 485 Austin, Faith Ruthless, Hal. We got Is No Good, Lee's iPhone, Pascal. We got Rodney. We got Schwaz. We got Sean. We got Stacy. We got Steven. We got Vicky. We got Victor. And our very special guest is Peter Klink with Tasty Trade. Hey, Peter.
How you guys doing?
Good. Thank you for being with us. We just want to make sure that we're using these wonderful tools that you have on Tasty correctly and making sure that we understand them. So we appreciate you being with us today.
Absolutely. Makes sense.
So what we do is normally we have something called a sweet Bobby hedge, or it's a kind of a black swan hedge, and we put it on. And then what we do is, the other day on August 5th, the VIX was up 40 points on a 4 or 5% move down. So what we generally do is test between 25 and 40% down. And we kind of look, my target is to look at what if we had a bad crash? What if we crashed 20%? What would my account do? And basically, this is showing that I'd be up 10,868. So we know that you guys are, had something to do with Thinkorswim in days past. And so we also tested it on Thinkorswim, and these numbers were approximate to what we saw over there. So we just want to make sure that we're doing them right. So Peter, I will turn the floor over to you, and you just walk us through anything you want to show us.
Yeah, so I'll just tell a little background. So I came from the trading floor. So I was in the same trading pit with Scott Sheridan and Tom Sosnoff, SB 100. And then got there right before the crash of 87. And then I stayed there to about 2006, 2007. And then I ran into Scott and Tom, and they were had started Thinkorswim, and they asked me to come on board. And then, of course, 2008, 2009 came, and I became the risk manager. So, which was good and bad. And then, so a lot of the analyzed tools that I built at Thinkorswim, right, I kind of brought over here to Tasty Trade. But the good part is that a lot of stuff I wanted to do there that I couldn't, because of, I had Schwab bought us at that time, and I was there at Thinkorswim to about 2021. They're going through conversions. There was no innovation, right? So I was able to bring those same tools over here and do some of the stuff I always wanted to put in to the risk tools. I mean, my whole thing always been is our best risk managers are our clients, right? So the more we give them tools, the more they can analyze their own risk and make their own decisions based on, like, you're looking at plausible moves, right? Plausible vowel shocks, right? Makes it better for everyone, right? And so I kind of created a tool where everyone can see display on risk arrays, right? Which I like risk arrays better than graphs. I mean, when I was in trading pet, there was no graphs. There's option chains, right? So we built everything on here so a client can best analyze their position, whether it be using futures, trading equities, stocks, puts. We use a Black-Scholes model, right, into our to calculate the gains and losses along the risk array, right? And then we kind of do it so where you have choices of, like, doing it using the betas, right? So you can beta weight your position, right? Which you see that override, right? You can beta weight. So we use Morningstar betas and determine moves based on betas. We also have it based on uncorrelated. It means we move everything the same. So if we move everything up or down 20%, moving all symbols up or down 20%, right? And then in override, we have none, which is just taking our house default requirements, right? So you can determine, what we're doing, showing in terms of for ourselves for requirements. And then as you go to the right, we also have the IV shift. So you can do IV two different ways, right? You can do a percentage, meaning we're going to move each individual option by 10%, 20%, 30% up or down, right? Or we can do by val points, which allows you to move everything the same, right? So if I want to move everything up 10 val points, then all my individual options are moving 10 val points from where they're currently being the Greeks are at. And then we also have a way of how far do you want to do pricing moves, right? 10%, 20%, 30%, which you can also help. You can do it also on change it here, or an override, change the percentages. So we think that's a really cool way of able to do your own risk analysis. I don't have any questions on that.
No, I just want to make sure that this is the profit and loss, though, right? We just want to make sure
Correct.
Yeah, okay,
Correct.
so that's the profit and loss.
We're aggregating all the profit, losses and gains, right? So if we're looking down 20%, right, we're taking all the loss and gains for each individual option, right, and aggregate them to a total. The other nice thing too, if you hover over the options, we also show the Greeks on there. So if you hover over, say like down 20%, and just hover over, like you're losing 26,980, whatever, down the bottom here. If you hover over, you'll also be able to see the Greeks. You just put the arrow over it, just hover over it, like right here. You should be able to see the Greeks in it too.
Where's it? Where do I see the Greeks? Where's this?
Right there. You just saw them. There,
Oh,
there
right
you go.
there, right there. Yeah.
Yeah. So you can also
Yeah,
see the
good.
Greeks that are coming out of the option pricing model,
Wow.
which I think is really cool. And then the nice part too is you can also change each one of your individual options yourself too. If you want to manually change it down here, you can go down there and change each one yourself and put your own implied volatility into the model, right? And we'll recalculate the field price of the option, right? So we get the field call, price to call, field price to put, which, you know, is also, if you want to do some, if you want to change it versus, different vols versus different months, right? Now, not everything moves the same, right? You know, a lot of times you look at a gamma and maybe people want volatility for first 15 days, right? You know, versus, out 6-day options, right? So you can make your own changes into, your front month versus back month, make your own kind of what if volatility assumptions, which I kind of like also.
What I like too, Peter, is that we can add, add a trade on here as well.
Yeah.
I've noticed that sometimes, and I don't know if it's because I need to log out and log back in, it gives me an error here. It says there's an exception sometimes when I try to add an order leg. You guys, and it says it's sending a report back to the development team. Are you guys aware that sometimes it does that?
I'm not aware of that, but I'll ask on that one. So what do you have to do? Do you have to log off and log back in?
Yeah, and sometimes it'll fix it and sometimes it won't. Let's see if we can do a trade now, because this
Yeah,
is
if you
kind of
see someone, and the other part too is let's go for more. So we can move the calendar dates up upper left, where it says evaluation. We can move the calendar dates in that one too. We also have ways of refreshing the price and IV. If you click on that, reset the price and IV. See market data. You can also the price also itself, underlying price, and then positions. In case you done positions not showing up in the risk analysis tool, you can click on that and make sure it adds on your new position that you just got filled on in active trading.
Good. Let's see if we can add a trade here. And like the other day, we were saying, and this was really cool. We were like, what if we wanted to add some UPRO and we wanted to buy just some shares? It showed it the other day. And so we went to UPRO and we went to trade and we were going to buy 469 shares. So we had this trade here, and let me clear it just and act like we were going to buy 100 shares. Let's buy 100. There we go. And then we'll go back to this and let's see if it'll give us that error, if it'll show it. No, it actually did it this time. It did it exactly correct. And what I like is this.
Bobby, usually it gives you the first time, but try it again because usually the next time you try to do it, like go click back up to the right corner, order legs X, and then do it again. See if it's gonna do it.
Oh, it's not doing it. Yeah, look at that.
Yep.
Yeah, if you uncheck it, then you have to go back and recreate the trade again.
Oh, recreate the trade again. Okay.
Yeah, right.
But what I loved about it is that UPRO is a 3x leveraged instrument, and let's see if it'll do it this time. And so we'll go here, add order legs. Yeah, there it adds it. And so the cool thing is, if the market's down 20%, we would expect this thing to be down around 60% or so. So the beta weighting thing does really good on that to show us how far down that would be, which is good. If you take it off beta weighting and put it on uncorrelated, then it shows it down. I thought it would show it down 20%. Let me do.
Yeah, whatever you can change it on the right hand side, or where here you can change this to be a different percentage.
Yeah, but that was kind of cool that it showed it down. You know what it should be when I beta weighted it about 60%. That was kind of cool. So Schwaz wants to know, what should the typical user use, non-beta or uncorrelated here? Can you go into more detail?
it just depends on, you know, how, I guess, how beta related your symbols are, right? You know, obviously, if you're trading stuff with not high betas, it won't matter much, right? You know, the question is, you know, with higher betas like a Tesla or Nvidia, right? You know, I think betas are important, you know, so I'll look at both, you know. I mean, every model is more than one scenario, right? You know, so I would look at both scenarios and see which one you think is more plausible. So that's why we give you both choices on that one.
Yeah, I like that. Anyone got any questions specifically of Peter at all about anything that we're doing here? I'm glad he confirmed that this was price though, because we had some discussion, was this buying power or price? And we compared it with.
So it's not buying
thinkorswim.
power, right? Exactly. Yeah. It just, you know, it's gains and losses, aggregate gains, aggregate losses off of each symbol's risk arrays, right? You know, I think a couple other things.
Yeah, what I like is that you can uncheck them over here and check how different.
Which is great right. So let's just say you have options, you have hedges on today, right? They're expiring today, right? And you want to see what your requirement or exposure be looking next day. What's nice about it, you can either uncheck your expiring hedges, right, to see what you have to place on for today, for example, or you can roll a date to tomorrow's date, right? And that will also, you know, take off those hedges that are expiring. So, you know, a lot of times you have hedges on just to make sure that you're good for next day, right? And that's a good way of using the risk analysis tool to see what your exposure looks for next day.
Yeah, that's really cool. What does this span scenario do? We trade a lot of futures.
This is great. So yeah, so this is great. So you know, with span, there's 16 different scenarios, right? So basically, they take a 1 day move, price move. So let's just say, for example, ES. Basically, if you take our margin requirements and divide that by notional, you'll get basically what a 1 day move is. Well, let's say for easy, the 1 day move is 5%, right? So in span, we'll go in there and say, okay, 5% move, vol up, vol down, vol steady. Then they'll do a then they'll do a third of a move, 2/3 of a move, the full move, and then they'll do in scenario 15 and 16, they'll do a 300% move, but they only count 33% of the losses as requirements. So it actually goes through all its 16 different scenarios. Whichever scenario has the greatest loss will be your requirement. Another nice thing there, if you hover over initial requirement, we actually break down the span for you. So if you hover over that, it will keep going to the left right over there. If you have a position on, it should show you. There you go. It will show you how span is calculated. The margin requirement, what scenario is coming from, right? Yeah, if the multiplier and the net option value always get calculated into the initial requirement. So we obviously, for models, we want to display as much possible for our clients, right? Some of these models you see in other firms, they don't show you anything, right? You just get a big number, right? What does a number mean, right? So what we want to do is kind of break it down to how span does their scenarios and kind of let the client customer understand where the requirement is coming from.
Okay, so that's kind of cool. So this is saying here, let's say, for example, this is saying, okay, market goes down 33%, volatility is
the price move. Yeah, right. The
of ES,
1 day move.
Right?
Yeah, right. It's not so much 33%, right? It's taking the price move of the 1 day move. So again, they take a 1 day price move, right? So let's say it's 5%. They'll take a third of that price move as one scenario. They'll take 2/3 of the price move as second scenario. Then they'll take the whole full price move of 5% as another scenario. And then they take 3 times that move as another scenario. So everything's based on a 1 day price move, and they just kind of cut it up.
Okay. Cool. So that's showing you the amount of margin that would be required to hold the positions. That's what that 11,670 is. Okay.
Well, this I mean, well, you're looking. I think this one you're making money on this one. Yes. So I think this is right. So they're gonna take which one of those scenarios has the greatest loss. That will be held as the margin requirement.
Oh, okay.
How do you determine 1 day move?
So this is done by the span methodology. To get a closer approximation, if you just took our margin requirement on the future and divide that by notional value, that'll get you roughly a 1% move. So we took ES, right, times the multiplier, which is like a 50. So it's, and then take that number, which is current trade now, and then divide it by the, or I think it's 16,000 per option, or I'm sorry, 16,000 per underline. You take that number, you would come out to be like 5.5%. And that's how they determine a 1-day move.
Anyone else got any questions of Peter? Or Peter, is there anything else that we need to see here? I've seen allocation before, which is kind of cool.
No, the other part, the cap report is kind of cool. If you click on cap report right before risk analysis, that also kind of tell you what requirement we're holding at. Now we have different tests. So we have obviously the requirement coming off from the scenarios, right? Of 10 different scenarios. We do a Vega calculation. You can see here, you don't have anything right here, but if you scroll to the right, you see alt minimum. This is for portfolio margin specifically. So the portfolio margin, we use a risk-based model, right, which is an option pricing model. And so we have different house overrides, to make sure we have the proper requirement on clients' positions. So we have, you can see alt minimum, the FINRA minimum is I think 3750. We do a Vega test on that. If the Vega requirement is greater than the risk raise, you'll be held on the alt minimum Vega. We also have a calculation, which is interesting. So, the question always is how do you consider your position concentrator, right? What makes a position concentrator, right? I could have a large margin debit, but have no risk, right? I could be long stock, borrowing money, right? Long put, right? And I have no risk, right? So what means concentrated? So we decided that we take the IVX, the 15-day option chain, because our thought is that the market makers know better where the stock's going than we are at times. So we take that 15-day option chain IVX and we do a 3 standard deviation move against it. So basically, if the implied vol is a 50%, right, and we take a 3 standard deviation move, so you're just taking, basically you're taking time to 15 days divided by time, square root that, comes out to be like a 0.6. In this case, we think that based on the option chain move, that the stock can move 30%, right? And so even though in portfolio margin, we may hold Apple or Tesla at 15%, if at 30% your count would go unsecured, meaning those losses are greater than that lick, we will give you a higher risk array of 30%. If at 30% your count does not lose, all the losses are not greater than your count net lick, then you get a 15% requirement. So that's our way for concentration. We think is a more fair way for positions that are concentrated. So people can trade small, but if they trade bigger and their losses can take down their account's value, we hold a higher requirement. And these calculations are all done in real time. Does that make sense?
Yeah. So everything that's here is basically to keep us from getting in trouble, so that there's
exactly
no surprises.
Exactly. We have other things that we've seen in the past where clients have gotten in trouble with, and we want to make sure that we have proper requirements for that. I mean, you can never guess on every move, right? But we've done stuff that over the years that we've learned that we think are really good metrics for clients to use and to hold as margin. If you go into more detail, we have the whole thing on our support notes. So if you go in tastytrade and you type in portfolio margin, we have a whole support notes explaining each one of these columns and how the calculation happens, and some examples on it if needed.
Now, Schwaz has a question. What is the difference between maintenance and requirement?
Yeah, for most part, it should be the same in a portfolio margin. Sometimes, like in span margining, you have initial and you have maintenance. And so if you don't have enough requirement to cover the if you have enough net lick to cover the initial, you go to maintenance. If you don't, you go to initial. So for most part, for portfolio margin offering, there's only one buying power. So initial and maintenance will be the same number. But for like span, you do have a maintenance versus initial.
What I've been doing is using the larger of the two, just so I don't get into any trouble. Well, we normally don't count bill, in our calculations, but
right. And also you want to always have a cushion, because you want to be able to trade things or absorb moves. What I'm saying, if you're trading your account where you're always full boat, right, where we don't have much buying power leeway, if you do get a good chance to make a good trade, you're kind of stuck, right? or if something goes against you, you have to start reducing off the bat, right? Because you kept yourself buying power too low in terms of your net leg. So, you know, it's always good to have a little cushion.
And let me ask you this here too. Maybe you know about this. Let's see, in there somewhere, let's see, if we do the thing here, the balance here, doesn't this tell us where if we're paying margin or something? I've asked them before.
Yeah, if you go over there, you have to look at your balance and look at your, you know, sell cash. And that should tell you if you're borrowing money not, and how much you're getting charged each day. Yeah.
Okay, so that
Can you
tells
go
us
into more
there.
detail? I'm sorry, I think, can you go into more detail? How do you know if you're paying interest? And
It's on your balance. It should show you. I think it does an aggregate of the whole month in terms of what you're being charged. Like right now, obviously you have positive cash, right?
Right.
You're not
go
going to
to
be
some
paying
other
margins.
accounts, probably.
So yeah, if you show me an account where you have negative cash or you're borrowing money, that might be an easier way of
Let's see,
showing.
there's cash and this, let me go down to this little one here, see what it shows. All
Well,
of
we
them
could
has
borrow money
positive cash,
Yeah.
but I think I've seen it actually in this little box say margin interest.
Yep, exactly. Yeah, exactly.
And
And
that's
it's
your
being
monthly
calculated.
margin interest then. That's what,
Correct,
okay,
correct.
the cumulative
Yeah.
for the month or whatever, if you've had margin interest. Because I
Right.
know a
I
lot
mean,
of us,
generally,
we hold like more bill than we probably should in these accounts, and then we trade options against our accounts. So we just want to make sure that while we're getting the 4 or 5%, you know, from holding the bill, we want to make sure that we're not having to pay margin interest.
right. Well, you don't want to make 10.5% to make 5%, right?
Yeah, exactly.
So exactly. So you just want to make sure that your cash balances are positive, right? And other, you know, especially when if you're trading futures, which money gets swept over to the future side, you just have to make sure that this cash balance is positive, so that you're not paying 10% to make it 5%.
All right. So Stephen has a question. He says negative maintenance excess if on margin. Is that this would be negative if you're using margin? Is that right? The maintenance excess, or what do we need to make sure is positive here? Cash and settled cash.
Yeah, cash and sell cash. Correct. You need to make sure that's positive.
Cash and settled cash need to be positive.
Yep.
So we don't need to necessarily look at maintenance excess.
Correct.
What is SMA?
So SMA is an old calculation that was done for Reg T. It's a way of not being able to trade on unrealized gains, unrealized profits. I mean, so you know, it's just like it's a calculation more geared toward Reg T, where it limits you to be able to trade or buy more where you have unrealized open position or PL.
Okay. Okay. And Victor, I'm sorry, I interrupted you. Victor, you had a question.
Yeah, I was just wondering if there's a way to estimate what the overnight requirements might be based on your positions for the futures for that for the cash swap that you mentioned earlier.
Yeah, so you just have to make sure that when you're looking at that your future requirements, you're adding that into your requirements. So you have to make sure that you know, obviously you have to make sure that you have enough cash or enough account value to cover both with your equity margin requirements and your futures margin requirements.
Right.
Because
but
if you
go ahead. I'm sorry.
No, that's fine. I'm sorry.
What used to happen to us is that we would have everything positive. There was cash balance available, but then because of the overnight swaps and things, we would borrow money overnight and then have to pay interest on that without us even knowing, because it would still show every time we log in, it would show positive balance here on cash. So we have no way of estimating how much cash cushion we should keep in order to make sure that there is we don't run out of cash overnight.
Just make sure that your future requirement is not greater than your cash.
What is it? Can you show that, Bobby? Just to make sure.
And the cap requirement, you know, you saw if you have $1,900 or your requirement is $1,000, make sure you have $1,000 to cover that you have $1,000 in cash. So when you move that money over, you know, to cover that requirement, it's not going to make your cash balance negative.
But what is your requirement? I'm sorry.
Go to cap report. That will show you your ES requirement.
Okay.
Right there.
So 900. That's what's required overnight.
Correct. Now there could be a difference because obviously if you had losses on there, there's some, you know, that could change it too. Or if requirement of FCM is a little higher than our requirement. Usually we're in check with them, but
yeah, but
there's so-
roughly,
yeah,
thank you very much.
roughly that, right? Yeah, 'cause you
Yeah,
have
this
to
is
take,
very
yeah,
helpful.
yeah,
Very helpful.
yeah.
Thank you.
I'm glad to help you.
Yeah, so this is what we need going into the night to hold in cash.
Correct. That gets swept over to the future side.
Okay. And then we go over here and I see that my cash is larger than that, so I'm good to go.
Correct.
Okay, that's very helpful. Very helpful. Anyone else got any questions of Peter? How is it working with Tom and Scott?
Well, you know, it's always great working with your friends, right? So I knew those guys on the trading floor. It was, you know, fun experience, and obviously, we think swim was a great experience, and now it's, you know, it's another great experience, you know, because you're working with your friends and colleagues. So that's always a fun time, right?
And y'all are getting to do some fun things with this platform.
We
and
are. I mean, and
adding new
that's the nice
features
thing
and-
about nice thing about with tastytrade, we can do innovation, right? Where other times you're just kind of stuck, you know, going through all the motions with, you know, a big firm and all these layers, right? Where here is that you can have an idea, you know, and we have good sounding boards here, and we can get it on the platform, you know, and then we also listen to customer input too. So like if you have ideas, like I think one of the things I'm going to put into the risk analysis tool, as I'm going to take in some of the big moves over the years, one day moves like 2008 bank crisis, 2020 COVID. So we're going to put some other historical dates into our risk analysis tool to see how your position would do. So again, you know, taking into consideration 2008, 2020, what the price moves were for that one day, as well as what the volatility moves were for that one day, and kind of give the clients a way of looking at their position on the extreme but plausible historical event.
And this is such a visual platform, Peter. I was a little surprised. I know you said you liked the array with the numbers in it, but I was surprised that you also didn't offer, kind of like you guys did on Thinkorswim, the graphs.
We do. We do have a function on that. We do have the on the other end. You can look at the risk analysis another way too, viewing with charts. So we should have it over on.
Is
If you click on
this chart here?
Yeah,
or?
exactly. Oh no. If you go to on the right, it should over here. Let me see. If you go to, we have an analyze tab that we also have. You go on the far right over positions where it says over, there's like an arrow over by accounts, not the arrow up, but the arrow on the side. So click that down. Yeah, go right next one. Other one, right? Click on that. Yeah, and then you click on an analysis. We also, you know, we also should be able to show a chart there too, I believe.
Oh, I see what you're saying. Yeah, the analysis. Then we have to go to trade and curve.
Yeah.
And analysis to show it like that.
Correct.
The only problem is you can't put all positions together. You have to separate them, right?
Like in other words, it's just showing the UPRO here. It won't actually show my ES positions and everything. It just allows me to do what I've got pulled up as a potential order.
Yeah, I mean, there's some stuff we could probably do on that to incorporate both of them. So that's a good suggestion. I think we talked about that.
Yeah, so like I've got a lot of ES positions, so I can go over here and curve analysis. Why is it not showing my ES positions? They're all checked. Let's see, let's go to 9/26 today. Not sure. Well, there it is.
Yeah.
Okay. I'm losing. No matter if it goes up or down, I'm going to lose. Okay. Jim said he came in a little late and he wanted to make sure that we understand the difference between points here and percentage. And I think I was right. Like when on August 5th, volatility increased like 40 points, even though this says percent. It would almost say VIX. I'm equating it to VIX. We're in the S&P 500 going up 40 points. Am I kind of right on that, or?
Yeah, so I look at it like, just look at your November 15 options, right? The first one, the 5 lot, was a 96. So if you moved it 10%, right? So that would move up 9 points, right? That would become, you know, So that's percentages. So just moving each one by percentage. You're taking 10% of 60, right? Which is 6 points, right? And if you're doing volatility points, it's just moving everything by a number. So one just moving everything by percentage, right? So 10% of 61 is gonna be 6 points, right? But if you want to move it 10 points, it's going to go to 71. So it's just a matter of how you want to look at it. If you want to do a move by percentages or a move by points. Some things I look at is like if the VIX is at 20, right? Okay, let's say the VIX goes up. Say one moves at 50% of the VIX, so 10 points. So you can move everything up 10 points, right? And that would change all your volatilities, each individual position of volatilities by 10 points, right? So just how you want to frame it and how you want to see it. Like for a portfolio margin model, we do an IV shock of 10%. So we have clients use the percentages because that's how we do the shocks.
Oh, so your shock is under percent, and then this number is 10.
Right. That's how we do it for a portfolio margin correctly, right?
Okay.
So it's just kind of how you want to view it and look at it. But I mean, I use both. So again, like you said, like I told before, like models they're not just one model, right? And there's different ways of modeling things. So we just want to give you all your own choices, right? And then you can kind of figure out which one you think makes more sense, more plausible, or they're both good, and just kind of compare them.
Okay. Any other questions of Peter at all?
Yeah, I've got one. Peter, I was trying to respond to you on the chat, but if Bobby, if you'll go over to your positions, here's what I was trying to ask you about. Go to positions. No,
under this was position,
and then go to positions, and then try what I was talking about is trying to, when you click on the different strikes and group them not in the same expiration.
Oh yeah, I had a problem with one of that. Let's say it's in this account. Let's do this one, and it wouldn't let me group. Like I wanted to group this and this together, and it won't let me group those because they're in different expirations.
Gotcha. Yeah, I'm not sure. I'd have to ask on that one. I'm not sure. Seems like that's because obviously it's going off a different future, right, and a different underline. But what you're saying, you just want to be able to group them all together.
Yes. So
Yeah.
even though
Okay.
they're in different expirations, we sometimes do a diagonal trade, and when they're in these different expirations, it won't let me click on this one and this one at the same time to put them in a group.
Got it. Yeah, let me ask on that one. So I don't know the answer, but
Okay.
that's just how they did it.
Yeah. Any other
That makes
questions,
sense.
Peter?
One more unrelated.
Yeah.
Any tips for getting better MES fills?
I mean, you just got to put the price in and feel it and where it's being worth. You think where it's being worth it. I mean, you compare that to the ES in terms of the bid and ask. Is there that much difference between what you're showing ES versus MES? Are you just saying the MES is just?
It was pretty bad on
Is it-
August Sophia.
Yeah, well, that's a different story, But usually I kind of compare to where ES is at, so to make sure that you're kind of in line to where it's getting filled on ES. You should, I mean, in theory, it should be exactly the same, right? But that's what I would be looking at for ES to make sure the MS is in line.
All right.
Anyone else? We're glad to have Peter join us from tastytrade with his wisdom. And if anyone's got anything else, we'll ask him before we let Peter go.
Well, yeah, we can always do another session too if you guys have other questions.
Yeah,
You want me to come on
appreciate your
another time?
Peter. This is excellent.
Yeah.
And we appreciate Schwaz getting in touch with you and everything and lining you up. And we just want to make sure that we're using the tools that are available to us. And this is really good though. And especially, figuring out if we need to pay margin interest, if we got enough cash in the account, things of that nature is really, really important. And we like seeing what happens to our accounts in the event of a catastrophe. So that
Absolutely.
we don't
I mean,
blow up our
I
accounts.
100%. I mean, you guys are your best risk managers, so it's nice to be able to use some tools and kind of figure out, plausible events, right, and making sure that you know, you're good with the risk, right?
Well, thank you, Peter, so much. We
Right.
appreciate you, and
Thank you.
thank you guys, all of you at Tasty Trade, for all that you do. We thank you so much for being with us.
Thank you.
All right, bye, everybody.
Thank you.